Okay, so what is this a clip about? We're about.
Okay, so this is the Money Guy show, and they're going to talk about investing advice that they're giving, just general kind of investing advice.
A general sort of.
Yeah, okay. And these guys are both certified financial planners and chartered financial analysts. They have a pretty good idea what they're talking. They know what they're talking about, but they're not going to get into what the risks are or why these things are bad. So we're going to take what they say and then we're going to elaborate a little bit.
All right, let's do it.
All right.
Old school one, because I use this all the time. Everybody used to go to get Money Magazine, Kiplinger's, or other things, and they would have the best performing funds of this year, or the best performing stocks of this year. And everybody run out and go grab those funds. And you look back and you're like, man, these things just did not do well. They had one good idea in 2007. They had one good idea in 2014. You have to be very careful looking solely at past performance, because there's nothing that ties into what we just talked about previously. We understand the valuation, understand dividend yield, understand earnings. It's much more than just how did it do last year? They might have gotten lucky. So those are all the bad influences.
So he makes a good point here. So there's a risk where they're talking about, okay, I picked something because it was really good last year. Okay.
How many times do people do this?
All the time, because they're just focusing on return.
Right.
Mm-hmm. They're not focusing on the risk, because the risk can change, right? Twitter was a good investment last year, 2 years ago. It has not been a good investment this year since Elon Musk took over, and now there's all this speculation it's going to be worse since he fired like half the people there, and he's changing their whole format.
Right. So remember, it's not only systematic. It's not only what the market is doing. There are other types of risks that need to be evaluated, and
a business risk. Maybe you have, maybe you have business risk. Maybe you have a crazy CEO now. If Captain Ahab's running the ship, then things might go bad, right?
Maybe they come in, they make a whole bunch of changes that are not changes that actually are good for the business, and everything goes down.
Right. So that's the speculation. So there's more risk now associated with Twitter than there was last year because of this buyout.
His hand is moving very fast.
Yes, it is. So now this next clip is going to be, they're going to talk about another idea of discipline in investing.
It's kind of amateur when you think that you can just go pick this great stock and do it. The next one is timing the market. That's very much a lack of discipline thing.
Yeah. And so even if you're someone, you listen, okay, guys, I got this. I'm into this show. I just went and analyzed the price-to-earnings ratio for every one of my holdings, and man, it's for off. I'm going to cash. I appreciate you guys helping. I'm going to cash. You might find that you get yourself in trouble because it's not that easy to move in and out of it, And so a lot of folks who this happen all the time, they try to time it. They try to get really cute with it, where a lot of winning the game is just being in the game.
Yeah.
So another good point.
Yeah, we could use a little bit of clarification. I kind of wish he had explained a little bit more on that.
So basically they're talking about what I was just saying. Talking about things, I thought things were bad, so I just sold. Right? But then when they started to go back up, I bought, but now I missed all the gains. Right? This is what's called opportunity cost.
All right, let's talk about that.
Because this is important.
Opportunity cost. Because that's where the real decision making comes into play here,
Right.
Trying to figure it out.
So and we'll get back to this slide later, but I want to focus on this first point. So it's basically just loss of the potential benefit from an alternative option, right? And the simple calculation for it is your opportunity cost is the best foregone option, right? The best option that could have happened, right? Versus what you chose. You just subtract it, and that's what you lost. So
the best case scenario minus what I really did.
Yeah, and we'll get into ROI and IRR later, but we'll come back to this slide in a minute. But essentially, yeah. So let's say, for example, Alasius comes to me and she says, I have a business opportunity. I need to borrow, $1 million. And this is what the cash payouts will be to you over the next 5 years, right? What I would do is I would do this thing called the capital asset pricing model, which is the most common thing that most people do, where I would sit there and go, okay, well, if I invested it in something similar to what Lacey's proposing, right, and I compare them together, or I compare it to, say, the market even, what is the return I should be expecting versus what is Lacey is promising me, right? Now, if the number turns out that, like, well, look, if I invest it in this, I'm going to do better than what Alacius is going to give me, potential return, right, with a little bit of risk I can factor in there, then yeah, I mean, that doesn't make sense. It's not, the numbers aren't sexy enough, right? Now, on the other side of the coin, Alacius could say, well, yeah, this is what I expect to be able to do for sure, but if this works out, potentially it'll be even more money. It'll be double what I'm saying, right? And I say, well, I'm not willing to take that risk. And then Alacius gets the money from somebody else, and sure enough, she gets the cut.
I do exactly what I said I was going to do.
Right. So that would be my opportunity cost, right? Because I took the other option, right?
The best option was actually the thing I presented you.
Right.
So we have to see how that turned out and subtract out what you did.
Right. But the problem is there's no way to really know that at the time. So you have to be concerning about that. But that's what you have to realize too, is there's always going to be a risk no matter what I choose, right? If I choose to do nothing, there's a risk because I'm not gaining anything, right? So I'm losing that opportunity to gain. So no matter what you choose, you're taking a risk. So once you get that in your head, it's not so daunting to sit there and go, okay, well, maybe this risk isn't as bad. But a lot of times people think, well, if I do nothing, there's no risk. It's no, because if you do nothing, you're losing all the opportunity cost.
Right. And you can really actually evaluate, the difference between any other option that would have paid you more than having your money parked in your savings account.
Right.
I mean, even just what the market did minus what your savings account did.
Right. So just, yeah. So just what they're talking about. I panicked because the market looked volatile or it looked bad at the time, right? So I sold, and then when the market came back, I lost money. So further prove this is an important concept. Let me see if I can get this over here now. Since nothing is working. It's our high budget show.
Duncan, we're color coordinated today. It's almost like we had a costume designer.
Yeah, thank you.
Or wardrobe department. I like costume designer better, though. I think
it sounds sexier.
It sounds sexy. Once we have a budget, we're gonna have a costume designer.
There you go. Makeup and hair and all that. So this is just this S&P 500. Okay. So right now we're just looking at 5 years. Okay. So you can see it goes up and down. It fluctuates, right? But if we're looking at, like, let's look at this moment here. Can you see where my mouse is, where the lines are crossing, where it dips really bad? So this was COVID, right? There was a big market crash.
Probably the famous COVID March-ish moment.
Yeah, mid-March crash. And then the government stepped in and invested what was it, like $1 trillion in treasuries to fluff up the market, which brought it back so that this crash didn't last very long. It lasted a few months, right? That would be political risk, see? But political risk in our favor, where the government stepped in to change the outcome of the market, right?
Hold on. Pause right there, Duncan, on
Sure.
that thought, because I want to point out what you just said.
Yeah.
You just said risk to the positive, and I think it's important to pause and zoom in on that point again, because we think of risk as money lost,
Right.
particularly, right? Like I think human nature is to think about that in a negative sense, but you just brought it up
in a positive, right? Good point. So risk, because it goes both ways, right? Because I could bet against the market, in which case that crash would have been great for me until the government stepped in, right? With the political risk by actually stepping in. But if I'm in the market and the government steps in, the political risk that changed the outcome would have actually been in my favor. So risk and return have an odd relationship. Typically, the general rule is more risk, more return. It's not always true, but if you want to get higher returns, you generally have to take higher risk. What you don't want to do is get something that's lower return for a higher risk, which is why it's important to do things like calculate it. Like Lacey's investment might be higher risk. So if the return is less than something that's lower risk, why would I take that? That would be insane, right? Why would I take higher risk to get less money? I should get paid for the risk I'm taking, right? And if the risk turns out that it works, then yeah, that was a positive risk for me. If it doesn't, then it's a negative risk for me. But you won't know until it actually happens. So in that case, yeah, that would be what's a positive risk. The key thing to understand with this is here's a theory called random walk, okay? So if you're investing in the market, and they were talking about discipline of just keep investing, the theory of random walk is, markets go up and down, right? Everything goes up and down over time. But over a long enough period of time, everything goes up. Progress is always upwards. It's not a straight line. It goes up and down, right? But it's generally upwards, right? So let's look at the maximum here for the market. Let's see if it'll do it for me. Oh, that's not right. Let's see if it'll do this. There we go. So this is the S&P 500 back to the 40s. Okay? As you can see, it's gone up and down pretty dramatically over time. But it always trends to go up. Right? And this goes all the way to today. See, up and down, up and down, up and down. But it always trends towards the up. Right? My favorite analogy of this was a friend of mine in grad school, and he used to tell this story when he'd explain it, and when he was teaching it, was imagine there's a blind guy with a seeing eye dog at the bar, and he gets really drunk. And he's trying to get home at the end of the night, but he's really trashed. He doesn't know where he is. So he's trusting the dog to do it. And since he's not really directing the dog or commanding the dog is going to go over here or maybe sniff a tree or go pee on a hydrant or, and it might take him a little out of the way, but eventually the dog will get him home because the dog can find the house, right? The dog will smell it, right? But that's random walk. It's basically the idea that the market is basically the blind drunk guy and the dog is just the fact that, yeah, business will generally go forward. It just doesn't do it in any sort of practical sense. It just sort of does it over time.
All right.
So
I like your blind drunk guy analogy.
I wish I could take credit. It wasn't mine, but it's a good sense. So when they talk about just discipline and investing, you just keep investing and waiting and you've got enough time, it's eventually going to go up. That's just the theory. The next side of it was, you could say the market will just go away or crash or whatever completely. You could guess the world's going to end, and eventually you'd be right. The smart money is not on tomorrow. And furthermore, if the market does go away, we're fighting over food and water at that point. So you've got bigger problems than your retirement fund.